Today we're going to discuss F5 Networks, ticker FFIV. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. F5 Networks is operating in the communications equipment industry and has an enterprise value of $7.9 billion, market cap of $8.8 billion. So you can see some net cash on this business. That's always a good sign for the quality of the business. They provide multi-cloud application security and delivery solutions in the United States, Europe, and Africa and Asia. So basically most of the world. Multi-cloud application security. So cloud security tends to be a pretty good industry. Deploy, operate, secure, govern applications, delivery products, a lot of lingo here, professional services, consulting, training, installation, maintenance, large enterprise businesses, has partnerships with public cloud providers like Amazon Web Services, Azure, and Google Cloud. So these are, of course, the three big players in the industry. Good to know. So beta of 1.09, nothing significant there, nothing significant from the share turnover. When we get down to return on invested capital, this is where we start to see the first interesting things. First thing that comes to mind is you can see 20 straight years of profitability. Anytime you have 20 straight years of profitability without a single year of losses, that is a very strong sign for a high quality business. I always like when I see that. The next thing I can see is that for most of this period of time, these are double-digit returns. In fact, I would count 9.99 as a 10% return. Besides 2003, every year since 2004, they have earned a double-digit return on invested capital, which is simply amazing. You do see some cyclicality in this business. They kind of bottom out in 08, 09. They get back up to 22% in 2011, 2012. They get up to 34, 36% in 2017, 2018. And then they're down back to about a 10, 11% return on invested capital since COVID. But before COVID, they were doing really good in the 28% range. Very strong returns on invested capital. This quick drop off really suggests to me either a COVID impact or some sort of acquisition that they did here that would raise their assets a lot and lower the asset intensivity of the business. But I would say generally this is a very good sign of a high quality business. What you can see here as well is when you go to these 10-year median returns, you see 24.3% return on equity, 24.3% return on invested capital. The fact that these two match means that you're not having to use a lot of debt to leverage up the business. They're getting their returns simply from the operating capabilities of the business. There's no financial leverage here necessary to achieve very good returns. Now, also your 10-year median margins look very, very good. Anytime your gross profit's above 50%, that's a good sign. To be in the 80% range is very, very good. Extremely high free cash flow and EBIT margins, 27 and 31%. Very good numbers there as well. So high quality business, that is for sure. The big question then becomes valuation. And we see a PE of 27 is quite high. So PE of 27 is going to be trading in that 4% range, 3.5 to 4% in terms of your current earnings yield, which means you're going to need a lot of growth to justify buying this business. They have some growth, but the revenue growth is in the single digits, 6.9%. Your assets has actually been growing faster than revenue, free cash flow, and EPS over the last decade, which is why you see a decline in your return on invested capital over the last decade, from the 20% range down to the 10 to 11% range. Again, there's probably some one-time impacts here. I doubt that that's a straight year-over-year progression, but you can see a lot of the revenue growth here. If we look at the last 10 years, you see a lot of single-digit numbers. So you're averaging out this 6.9%. You do see a 16% here, 10% here, 10% here, but you see a lot of 3, 4% as well from 2016 to 2022, a lot of 3 and 4% numbers. That's okay, but again, this growth is not very high. So what you're getting is a very high quality business trading at a high price, and your growth is not necessarily going to bail you out because you're trading at such a high price. Your EPS likewise is not growing faster than your revenue, which means you've probably maxed out your operational leverage. So your free cash flow margins aren't going to be able to expand that much heavier beyond the gross profit margins than you already have. And so really your overall future growth is really going to come from this revenue line. Likewise, we can see the EPS growth. You started at $3.50 per share. You end up at about $5.27 per share. Now, that doesn't tell the full story because you can see from 2013 to 2019, you did double in about a 6-year period, which would be double-digit EPS growth. That's really strong. The problem is starting in COVID, you had a fall off. So what is that impact? Maybe they had to start paying higher amounts for the cost of labor. That could be a big impact there. Or maybe they had a big dilution event when they made an acquisition in this time frame. We're going to have to dive into the income sheet and balance sheet in order to get a better look from that as well. But overall, I don't really like how the operating profit is flat over the course of a decade, because that means that even if you had a per share impact here, the base operating profit is not that much better. Even though your revenue has gone from 1.5 billion to 2.7 billion, your operating profit hasn't gone up much, and that is a little bit of a concern. It shows that you're going to be having SG&A kind of growing out of your control, and it's not a very strong sign for you as a potential investor. If you're enjoying this video so far, hit that like button. Please don't forget to subscribe as well. So let's go to the income statement. You can see, of course, that their SG&A is growing rapidly, just like I thought. And you did see kind of like a step change in 2019 to 2020. Again, that big jump there is responsible for dropping your operating profit. Your gross profit has been growing pretty reliably. You're up almost 80 to 90% over the course of a decade, but you've more than doubled your SG&A, and that's a big difference in terms of how your operating profit is able to grow. You actually didn't have a dilution event, it looks like, from 2019 to 2020. Shares outstanding stayed about the same, and they've been about the same for the last 5 years, but you did have share buybacks for the years before that, going from about 80 million shares outstanding down to 60 million shares outstanding. That's pretty good that you're buying back somewhere in the range of 15% of your shares outstanding over the course of a decade. I like to see that amount of share buybacks, but it looks like they've kind of fallen off in recent years, so you'd want to study a little bit why that is. Let's go to the income statement, the balance sheet. It's interesting. So investments kind of dropping over time. PP&E starts out at basically nothing, $60 million. You did grow to about $400 million in PP&E, but that's really not much. I mean, you go to compared to this income statement, PP&E $400 million is, you're getting a 75% return on your net income line based upon that number. Now, so the big jump here is, of course, in goodwill. Your goodwill went up rapidly from 2018 to 2020. That's showing your acquisitions taking place where they're paying above those net assets, and that's going to be really the drag on your return on invested capital. But this is all intangibles and other intangibles and goodwill. It's not actual PP&E. So your return on net tangible assets is still extremely high with this business, and it's approaching 100% on an operating basis. Very good numbers to see 100% type returns on your tangible invested capital. It's not unheard of when you're really providing services, and in the cloud services business, that's why you're able to get such high returns. It's probably a space where you really want high performance and you're a little less concerned about price. That always offers a little bit of pricing power for you as a business, and it's a good sign there. They brought in a little bit of debt for a couple years here, but not that much. Let's go to the cash flow statement, where we're probably going to see where this acquisition take place. And you can see they made 3 acquisitions in a row, 2019, 2020, and 2021. And that's really what's driven this downward part. You see this 36% return on invested capital here. This quick, rapid drop into the 10 to 13% range is due to those acquisitions impacting your balance sheet and raising your goodwill from 500 million to 2.2 billion rapidly over the course of a few years. So when you 4x your goodwill, that's what you're going to see. It's not actually a deterioration in the business. It's not actually a cyclicality in the business. It's just an accounting item. So it's not something I would worry about at all. You would want to have some idea of how many acquisitions they're going to make in the future, because that impacts where they're going to be spending their cash flow from operations. But overall, not a bad sign. You can see in general, they've been buying back shares each and every year. So that is a little bit of a concern that you're buying back shares each and every year, and yet the shares outstanding only went down for the first few years. You can see that they were rapidly buying back shares for this period, but starting in 2019, the share buybacks stopped doing anything. And yet they're still spending $500 million a year for the last 2 or 3 years on share buybacks. Where is it going? It's to offset the stock-based compensation. And so what's interesting here is whenever you actually get into the deep accounting on stock-based compensation, you can see that they penciled in $240 million in stock-based compensation for 2021 and 2022. And yet they bought back $500 million, and yet the shares outstanding is flat. Why is that? It's because the actual numbers here on stock-based compensation understate mitigate the total value and the cost of that stock, especially at high stock prices. And so you're spending $500 million to buy back $250 million of stock-based compensation. The real way you want to think of that then is that you're really going to have to take that difference in $250 million, and it's lowering the actual cash from operations, because you're really paying your employees that much more than you're stating in order to buy it back. So something to be aware of is that they're actually doing a lot of stock-based compensation. When you see this number being a significant portion of your net income and cash flow from operations, it means the employees are costing a lot of money here. And so that's what's really happening. Not only are the employees costing a lot of money here on the stock-based compensation, we already highlighted how they're costing a lot from the SG&A. So you should be aware that that's a continuing problem for this company, is they're having to pay a lot of the money, a lot of the earnings from operations from this business out to employees. It's why, despite their growth, they're not really adding a lot of extra value to the shareholders on the bottom line over the last few years at least, even though they have across the decade. I like that they're not really leveraging up a bunch of debt, but again, those buybacks that is taking almost all of your cash flow from operations is really just being sent back to employees when you don't see the shares outstanding declining. So that is my concern here with this company. I actually really like everything I see here besides the heavy stock-based compensation. If the company changes their capital allocation, this is going to be a very interesting business to own because of the high returns on invested capital. The biggest problem with these tech-based businesses a lot of times is how they pay the employees, how they're compensating them, what those incentives look like. When you have an incentive structure here where they can report high cash flows, you get these high margins, but really these margins are overstated, because what this is doing is it's saying, hey, we're not actually going to count all of our payment to employees within our margins. We're going to report high margins, but we're actually going to pay our employees with stock on the back end, and then we're going to use that free cash flow to buy back that stock. And it's kind of a circular argument that you get into. So yes, the business is performing very well. Yes, you have these really nice margins, but there's the understated amount that's being paid to that's being paid to employees that isn't getting back to shareholders. It's kind of crazy when you think of these high returns, and yet there are no dividends being paid to shareholders. It's like all that money is going to the employees. And so there's a lot of businesses like this in the tech industry. And I just think where this company would get interesting is if there's a change in capital allocation, if they pull in their stock-based compensation, or if they eliminate the stock-based compensation, then you could get a really interesting business setup as those buybacks start to have a big effect on the share count outstanding. Until that time, this would be a company I'm going to pass on. But if anyone's just interested in a high-quality business with very strong returns and what seems like a strong moat, then this is something that you could get interested in. Until next time, stop paying fees, start building wealth.